Hey traders, and welcome back to another edition of Trade Like Assad. In today's video, we're taking a closer look at breaker blocks and how you can leverage them to stay ahead of market moves. Gaining a solid grasp of this concept will sharpen your ability to spot high-probability trade setups on the chart and reduce the chances of missing out on ideal trade entries. We'll also cover the different forms of candlestick breaker blocks, along with trading strategies and price action behaviors tied to breaker blocks that commonly show up in the market. On top of that, we'll walk through the essential rules and criteria for spotting quality breaker blocks and crafting solid trade setups. So, if this is the kind of trading content you're into, make sure to hit that like button to support the channel, and if you're new here, don't forget to subscribe. Catch you right after the intro. Welcome back, traders. Let's jump right in. Starting with the fundamentals, what exactly is a breaker block? A breaker block refers to a previously invalidated order block that transforms into a significant supply or demand zone on the chart. This typically happens when an earlier order block is breached in the opposite direction, causing it to flip its role, shifting from supply to demand, or the other way around. In simple terms, a breaker block acts as a zone for position mitigation and is often revisited for position re-entry or additions. But here's a pro tip to keep in mind. Whenever price breaks through a significant demand or supply zone without reacting to it, that zone flips its role. A supply zone turns into a demand zone, and a demand zone transforms into a supply zone. This same concept applies directly to order blocks as well. There are several reasons why the market may overlook the supply or demand within an order block. These include market structure shifts, an overbought or oversold condition, a reaction to key zones on higher timeframes, the impact of major economic announcements, or other fundamental influences. When a valid demand-side order block fails to reject price and the market breaks below it, the zone is reclassified as a supply level, now known as a breaker block. In such cases, it's generally anticipated that the price will react at this level and continue moving downward. Now let's explore the psychology behind breaker blocks and understand how they function. Imagine a scenario where there's a bullish break of structure above the previous high, leaving behind some inefficiency. This movement creates a valid order block linked to the recent structural break, giving a potential long entry. But if the price then causes a market structure shift by breaking and closing below the latest low, the bias turns bearish. As a consequence, our earlier demand zone transitions into a supply zone. Once the price drops through the order block, it becomes a breaker block. The underlying psychology here is that traders who entered long at the order block during the earlier structure are now trapped. They anticipate a return to break-even so they can exit without loss. The mass closing of buy positions in this zone triggers a flood of sell orders, generating strong bearish momentum. At the same time, retail traders often view the market structure break as a trendline breakout. They wait for a pullback to validate their strategy and initiate short entries right at the retest zone, which aligns with the breaker block. More traders also short this level because they recognize it as a key supply area. All of these actions combine to make the breaker block a high-probability supply zone, typically leading to price reversals. However, keep in mind that breaker blocks tend to be more powerful in strong bullish or bearish trends with minimal retracements, especially when price action disregards the usual premium or discount supply and demand zones. Now, let's move on to the next section and learn how to spot breaker blocks using candlestick analysis. In a bullish setup, a candlestick-based breaker block is identified as the zone that failed to hold back price movement. This refers to the final bearish candle that appears right before a strong upward impulse. Typically, this candle dips below or sweeps liquidity from the lowest point of the candle that came before it. Take this bullish example. We highlight this red candle as the breaker block. It marks the last bearish candlestick before price surges upward, having breached the low of the previous bearish candle and successfully swept its liquidity. In a similar pattern seen in the second candle sequence, this would be the last weak bullish candle formed just before a sharp upside break, again breaking beneath or sweeping the low of the previous candle. These exact ideas also apply in bearish conditions. Keep in mind, these techniques are effective on multiple time frames and work on any price action chart. Make sure to stay tuned and watch the video thoroughly. In the next section, we'll go over the criteria and rules in detail. To spot valid breaker blocks and evaluate setups that make them optimal entry zones for executing successful trades, we must follow a specific set of criteria and rules. The first rule for confirming a valid breaker block is that price action must first take out a clear zone of either buy-side or sell-side liquidity before a market structure shift takes place. Here's a pro tip to keep in mind. When spotting a valid order block, price must break and close above a recent swing high or below a swing low to confirm a proper break of structure that aligns with the order block. However, this condition doesn't apply to breaker blocks. In their case, it's not necessary for the candle body to close above or below the recent swing low to confirm its validity. The second rule states that in a bullish setup, price must make a strong move that results in a higher high, while in a bearish setup, it should produce a lower low. This confirms that price has moved decisively upward or downward across multiple candles, helping to filter out any sudden single candle spikes or dumps before a market structure shift takes place. This step is crucial, as it helps us avoid depending on manipulated price movements or sharp moves caused by emotional reactions in the market. The third rule highlights that after the market takes out buy-side or sell-side liquidity, the price action must begin to reverse direction. The fourth rule explains that a breaker block is only valid if the candle body breaks and closes beyond the breaker block. Simply piercing the level with a wick or shadow does not meet the requirement. Rule number 5 states that breaker blocks are valid for one-time use only. This means we focus on the initial reaction when price first reaches the breaker block. Once it has been mitigated, it should no longer be treated as a key trading zone. Now, to apply all these rules and criteria, let's take a look at a real chart example. We're analyzing the EUR15 United States dollars minute chart. At first, the chart presents a swing high followed by a swing low. Shortly after, a strong bullish move occurs, breaking and closing above the previous swing high. This action establishes a valid order block, indicating increased demand for long trades. Once the buy-side liquidity is swept, the market makes an unexpected reversal after printing a higher high, and begins a downward movement. It eventually breaks and closes below the low of the last bearish candle, confirming a market structure shift. This level now acts as a bearish breaker block, implying that buyers who entered this zone have been liquidated. Since a bearish structure shift occurred and the demand zone has transitioned into supply, we expect price rejection from the breaker block followed by further downside continuation. As illustrated, the price briefly retraces and stalls within the breaker area, gathering more buy positions, before gaining bearish momentum and moving downward. Moving ahead, the first high-probability breaker block setup with strong potential appears immediately after a liquidity sweep pattern emerges in the market. As previously outlined, a liquidity sweep refers to a single candlestick that clears liquidity positioned just above or below a recent high or low. This specific pattern usually leads to a rapid and sharp market reversal. Under such circumstances, we look for an instant directional shift in price right after the sweep takes place. Once liquidity is taken out, we anticipate the price to swiftly revisit the range near the most recent swing high or swing low. We identify a liquidity sweep by spotting a candle with a notably long wick or extended body, which is then followed by a sudden and strong price movement that results in a market structure shift upon closer inspection. We observe that the price has created a valid and unmitigated breaker block exactly where the last bullish candle appeared before a significant drop. This breaker block satisfies all the criteria for an ideal setup. The market cleared sell-side liquidity, then quickly reversed, forming a market structure shift by breaking and closing above the previous low. In this case, the breaker block sits just above a fair value gap. Relying on the fair value gap for an entry could lead to a missed opportunity, as the price may not return to that zone once it moves away. Instead, we expect a reaction from the breaker block, not the fair value gap. Hence, the entry should be placed at the top of the breaker block, with the stop loss positioned a few pips below the fair value gap. When planning your trade execution, there are two entry strategies to consider. You can either go with a direct entry using the current time frame, or adopt a more conservative approach. This involves waiting for additional confirmation, such as a lower time frame change of character within the breaker block region identified on the higher time frame. The second high probability setup arises when a breaker block aligns with a major liquidity void in the market. This usually takes place when the price breaks through the breaker block inefficiently, creating a gap or imbalance that leaves the breaker block area sitting within this void. Such a scenario provides a strong opportunity to place high probability buy or sell trades, as the imbalance often draws price back to that zone for a reaction. Another high probability setup occurs when a breaker block aligns closely with an order block. In such cases, the order block forms near the breaker block zone, creating a strong confluence area. These setups are especially effective because they mark zones where significant institutional activity previously took place, and it's likely that pending orders still exist in that region. This increases the probability that price will revisit and react to that area. In this example, we've identified a valid breaker block paired with an order block. We place our entry at the highest point of the breaker block and patiently wait for price to trigger the setup. That's all for today, traders. Thank you for watching. I hope you found this video informative and valuable. If you did, don't forget to hit that subscribe button and turn on notifications so you never miss an update on our latest content. We genuinely value your feedback, so drop a comment below and let us know what topics you'd like us to cover next. Your input helps shape the direction of our future videos. Thanks for your continued support, and we'll catch you in the next episode.